So the World Gold Council recently released a report saying that in 2018, global central banks bought more physical gold than any year since 1967. And if you know your history, from basically 1967 until President Richard Nixon closed the gold window, thus ending Bretton Woods, or the international gold standard, where other countries could exchange their dollars for gold. The dollar was as good as gold, and there was a run on gold, including like Jacques Rueff and France taking an enormous amount of gold and physical gold delivery of it, and them sending a destroyer over here. You know, there's a bunch of movies and books about that if you want to go back and read it. But basically, I think the reason that central banks are accumulating so much physical gold lately is as a hedge. They're not necessarily good market timers. These central banks in general are not, most of them are academics. Most of them do not have any real market experience or trading experience. And I think, you know, rather than saying that this is the bottom in gold, we're at 1310, I think the last time, around 1310, the gold price in dollars, the last time I looked at it. They're just saying that, you know what, we need a hedge against the dollar, we need a hedge against the euro, we need a hedge against the Japanese yen, and we need a hedge against the RMB or yuan. Because there's big problems in all of those major economies, and there's big problems with all of those fiat currencies. So basically, there's a problem now with trust and trusting those economies, those central banks, those treasury departments to manage those currencies, and there's counterparty risk. And I think that's why you've seen, according to David McElvaney, who did his podcast yesterday, he talked about a 74% year-over-year percentage increase in physical gold increases by central banks. And yet the demand for physical gold by retail Americans is down a lot. So central banks are increasing their gold holdings, while Americans who are probably still chasing stocks. So I'm doing this short little show today, live stream show, to bring up that report. I'll attach a link to more of the report in depth if you want to take a look. Thought that was very interesting. But the gold mining sector, I wanted to talk about that a little bit. So we have oil prices right now at WTI at $52.53 and Brent crude at $61.63. So hopefully the gold miners and the silver miners, because we've had a rally in silver as well, silver is up to $15.73. Hopefully we will see a little bit better earnings from the primary gold and primary silver miners over the next quarter or two. With higher metals prices and lower energy prices, hopefully the miners will be able to have a little bit better margins, have some earnings, a little bit more free cash flow, maybe control some of their costs. I don't know, because I've heard from Nolan Watson when I interviewed him last in my conversations with him that labor costs and other costs are starting to rise. So just because energy costs are still low does not mean that the miners have all their costs contained and their margins are going to be superb. So the mining industry is still in peril. We'll see what happens when the miners, a lot of them, the primary gold miners, primary silver miners, start to announce the earnings to see if they're getting a little bit of a bump. But the gold and silver prices we are at, guys, is not really benefiting the juniors. They are not, unfortunately, we are not in a gold and silver market right now. And the market has changed a lot where a lot of these juniors can go out and raise capital. So over the last like 3 to 5 years, a lot of the juniors' options in terms of being able to raise capital. So juniors used to have different options to raise capital. If you're not familiar, they used to have like investment banks or merchant banks. They used to be able to go directly to retail investors. They used to have a number of different options to raise capital, to go out and do drilling programs, keep the lights on, etc. And over the last 3 to 5 years, a lot of the capital that in the past was available to junior miners to go out and drill, it is not there. That capital has been reallocated almost entirely to gold mining stock ETFs. So basically you have the producing miners that have taken the capital away from the juniors, and a lot of those investment banks in Canada, it was not profitable for them to do bought deals and other sources of financing for juniors. It wasn't as profitable as it was in the past. And so they've moved on to other businesses. Normally in Canada, the main businesses are like consumer loans, real estate loans, home equity loans, and they're going to eventually have a problem with that in Canada. But the main sources of financing for juniors now are the larger mining companies who maybe want to do a little bit of an investment, maybe a joint venture deal to do some drilling, and they can farm in or buy into some type of deposit, or the royalty and streaming companies. So companies like Osisko Gold Royalty, Sandstorm Gold, and others have already made some equity investments in some of the best juniors because they have geologists on their staff, really good ones with good track records. But they also have, and this is not priced into any of the royalty and streaming companies that have done these types of deals because it's not immediate cash flow, but in the long term, these types of smart forward thinking will pay off. They're called right of first refusals, ROFRs. And so a lot of these potential new mines, and this is gold price dependent, silver price dependent. So if we get, this is a hypothetical, if we get a gold price $1,500, $1,600, $1,700, say each $100 increase in the price of gold, more potential new gold mines become economic. So companies like Osisko Gold Royalty and Sandstorm Gold have already locked up potential new gold mines with right of first refusals on gold streams or silver streams or byproduct streams already. And obviously, in my opinion, none of these things are priced into any of those stocks. So these companies have a lot of future growth in the pipeline. It's not paid for yet, but it's contractually locked up, and those contracts can be amended. So there's ways to amend the contracts in terms of, let's say one of those juniors, this is a hypothetical, that Sandstorm Gold has a RFR with, that Nolan Watson negotiated with years ago when the gold price was higher, gold prices come down, and all of a sudden they raise some capital, they go out and drill, and they find an enormous mine. And the capex to build the mine is going to be too much for Sandstorm Gold to handle. Sandstorm Gold has ROFR on that mine. They could amend that contract there and probably put a syndication for the stream and split a gold stream then with maybe one or two or three of the other large royalty and streaming companies. Or Sandstorm can sell it if it's too small. They can sell it maybe to a Mavericks Metals or a Metalla, one of the smaller, or Abitibi royalties, although I think Abitibi focuses more on paying dividends to Rob McEwen rather than growth. So the mining industry is still in peril. We'll have to see what happens to the earnings, but this is good for physical gold demand. I don't think the central bankers are doing market timing. In general, they have a very poor history of buying and selling gold at the exact wrong times. But I think, in my humble opinion, the main reason the central banks are accumulating physical gold is because of the increased risk with all the basically 4 or 5 major fiat currencies. The dollar, the euro, the Japanese yen, and the RMB. There's enormous risks and mismanagement in all of them. So I wanted to talk about that. In addition, I wanted to bring up a few global macro stories. So one of the main reasons, besides the Federal Reserve comments from Jerome Powell and them deciding not to hike rates further, at least not right away, although Janet Yellen said today that she could see a scenario where either rates are hiked or rates are cut. Good to hear Janet Yellen's flip-flopping. But one of the main reasons, in my opinion, that the stock market has had a rally for, I don't know, the last month or so, is because Daniel Lacaille talks about this. There's a good chart on his Twitter. I've interviewed him many times over the last couple years. He just put out an article, too, I think, about why the European Central Bank QE failed. But he has an interesting chart there showing how the global liquidity increases, the global money supply. It was going down from, it peaked around March of 2018, and over the last month or so, it started to increase a lot again, mostly because China has done an enormous amount of liquidity injections, and the European Central Bank hasn't fully stopped QE. But the global money supply, the global liquidity, the amount of liquidity injection by central banks, after being in a big downtrend since early 2018, the last month and a half, 2 months, it has rallied now, and it is now back at March of 2018, close to March of 2018 levels. There's a chart of this inside the Wall Street for Main Street Facebook group if you want to take a look. So this, obviously, if Daniel Lacaille is correct, and I believe he is about this, this is not a fundamentally driven stock market rally. There's a combination of liquidity injection still from central banks like the People's Bank of China, maybe short covering rally. And if you've paid attention to the earnings releases, almost all of the earnings releases from a lot of the major companies in different industries have not been good. There has not been, raising of guidance. So basically, if you're not familiar with what raising guidance means, you have the executives of the company saying that we're expecting increasing revenues, increasing earnings, increasing free cash flow, better margins. Our industry, the prospects for the near-term growth for our industry is looking really good. You're not seeing that. So you're seeing spin from a lot of these companies where they've maybe lowered the expectation bar and then they beat by a penny or two on the earnings. Or they try to say that things are bad now in the global economy, but we expect the second half of 2019 to improve. But pretty much across the board, guys, and I've talked about this a while too, but there's a lot of new incoming anecdotal evidence from a lot of these companies reporting earnings and guidance that the numbers are just not good. The global economy is slowing down. Things are getting especially worse in the European Union and China. Those are the two main problem spots, it seems, for right now. So I wanted to touch on that as well. We had the State of the Union on Tuesday. President Trump gave a great speech. Unfortunately, it doesn't fully reflect reality, especially economically. He didn't mention any of the debt increases, how the public debt is up $1.1 trillion more, how the Federal Reserve, all the fights. He didn't mention any of that. It was all, positive spin. So the U.S. is eventually it's being given right now more rope to hang itself with. The market is more worried, in my opinion, about emerging markets in Europe, the European Union especially. And for the short term, at least, the markets may go higher. It seems to be in a rally. It's not fundamentally driven, though. So if the central banks, especially the People's Bank of China, is going to do liquidity injections, I doubt a lot of that capital and credit's going to stay in China. It's going to leak into commodities. It's going to leak into U.S. stocks. Do you see the point I'm making? And actually, on the recent McIlvaney Weekly commentary yesterday that was released, he had an additional source in China, he said, that was risking getting arrested or getting killed, that confirmed how bad the Chinese economy was. So he said his China source, who is in China, has lived in China for many years, confirmed that things are much, much worse in China, the real economic data, than the government data is claiming. But if China's going to intervene, they're going to do market injections. The money's probably, no one's going to hold the cash probably. No one's going to hold the RMB or the credit. The money's going to go probably into asset prices outside of China first. And this is a new normal. This is what caused the everything bubble in asset prices. And, meanwhile on Main Street, we're getting killed with inflation and taxes while these crazy Democrats, these radicals, are talking about, taxing us more, eliminating all these things that we use every day in the real economy, trying to get rid of cow farts and people flying on airplanes, totally eliminating that in 10 years or less. Just really ridiculous stuff. A couple more current events before I let you guys go, because I want to keep this show fairly short today. I am working, by the way, on a short video highlighting the tax policies that the radical Democrats are doing. So I spent over an hour today working on some of that for my slides, and I'm going to be working on that and hopefully getting that out over the next couple days. I think some of you will enjoy it. Okay, so on January 11th, 2019, there was a Reuters article. I'll attach a link for you guys to take a look at this. These are macro topics that I want to bring up before I let you guys go. So U.S. Federal Reserve may need to backstop the repo market. Oh my God. So it says, I'm just going to read some highlights of it. It says the $2.2 trillion repurchase agreement repo market enables banks on Wall Street to raise short-term cash to finance their trades and loans by using treasuries and other securities as collateral. And in this article, it's interviewing experts suggesting that the Federal Reserve may need to guarantee or backstop the entire market. It's basically similar to what happened in 2008 with the commercial paper. There's probably a bunch of... This article doesn't touch on the amount of derivatives in there that could be exposed. But it says the general repo market is $2.2 trillion. We don't know the exact amount of derivatives attached to those as well. Something else that got me... something else that interested me was on Monday, there was a report released, I think, by the Federal Reserve and the ECB research saying that negative interest rates would have helped the economic recovery. These academic economists who are making like $65,000 or more, some of them are making well over $100,000 a year, they're a waste. They distort things, they destroy the economy, they cause bad policy decisions. We're going to have these academic economists and central bankers screaming about how bad deflation is like nonstop for years. They've been doing this all the time, by the way. Meanwhile, they have an inflation of targeting policy of 2% inflation. Everyone here in Main Street who listens to this podcast on Main Street USA knows that you're being killed every year with inflation and taxes. So in the real economy, while the academic economists and the central banker economists and the government economists are coming up with new ways for economic propaganda with new formulas and equations and tweaks here and tweaks there and adjustments here, hedonics and all this other garbage, the people on Main Street, I graduated college 12 years ago. My bills have doubled. Okay, my food bill, consumer staples, pretty much all my bills have doubled since I graduated college. It's you can chime in if you talk about your bills with healthcare and so many other things. And so this is being blamed on, you know, free markets and capitalism. Meanwhile, we have these academic economists that are also contributing to the problem because they're saying there is no inflation. Go look at the Chapwood Inflation Index. It's free. And they sample like 500 consumer items in all the major U.S. cities a couple times per year. Ed Batowski's been doing this for a long time. I interviewed him years ago about this. And the real inflation rate in every single major U.S. city is between 7 to 13% per year. Okay, that's stagflation. We have stagflation in the real economy. And for Real Vision TV, they released a very excellent discussion, if you're a subscriber, this week between Brent Johnson and Luke Roman about the dollar. And so I think and Grant Williams was moderating it. I think it's a very interesting conversation. I was talking with Brent Johnson more about this. And basically, I think because of the distortions and how brainwashed even these academic economists are, many of these people, academic economists with PhDs, are very smart people. They just have no common sense. And so basically they're going to be tweaking the numbers or saying that there's not enough inflation or inflation's only 2%, you know, meanwhile, or the dollar is getting stronger. The dollar index today is at 96.57, so it's rallied. I think it was almost to 95 at some point last week or so. So it is kind of in a range, but it has rallied. It hasn't stayed above 97 on the dollar index. But I had a discussion with Brent Johnson, and this is not a public discussion, but I'll just summarize it. And basically, I was telling him that even if the dollar rally continues, or the dollar stays flat along these levels, like sideways, that everyone in government, all the academic economists, all the central bankers are going to be screaming deflation. Oh, we have a strong dollar. There is no inflation. We need more inflation, blah, blah, blah. Deflation's the enemy. Meanwhile, on Main Street, your bills are going to go up. Inflation and taxes, you're getting killed with stagflation. Stagflation may get worse. So we're in a scenario here where there could be more inflation accelerated by the central banking policy, but even if the dollar kind of stays in the level it's at now, that you're still going to see a lot worse stagflation, while the people in power, the people who are making economic policy suggestions, who are releasing corrupted economic data, they're going to be saying that there is no inflation. So welcome to dystopia. A couple more stories before I end this. Lastly, there was a article that the New York Times put out on February 4th, and the article is it's summarizing like an Australian government report. It says Australian banks overcharged clients even after some died, report finds. And if you really want to dig deep, I know we have a lot of Australian and New Zealand listeners out there, but basically these Australian banks were so immoral. There was so much moral hazard. There was so much willingness to take on risk, to make their commission, to give out mortgages or loans to people who couldn't afford them. Basically the same type of stuff, predatory stuff, that occurred in the 5 or 6 years prior to the 2008 financial crisis here in the US. So there's a lot of very similar tactics. If you want to read about the details of it, you're welcome to do so. I will attach a link to the New York Times article in the information section of this live stream show after it's done, if you want to go and read the New York Times article, which is a summary, or you want to actually go read the report. But basically, you know, until enough people, and I don't think, by the way, guys, that any of the, even though this report is supposedly scathing by the Australian government, I don't think any of these bankers or banksters, many of whom made a lot of money off these real estate bonuses and commissions, and now people are underwater in their mortgages, and Australia's having real bad problems with their housing market. And I think even the investment banks in Australia now are predicting like lower and lower real estate prices. when they were perma-bullish for many, many years. That unfortunately, I don't think many of these bankers in Australia, for doing almost the exact same stuff that the American bankers got away with, I don't think any of them are going to go to prison, or very few. Okay, well, I can take a look at listener questions and comments really quick. I covered pretty much everything that I wanted to cover. So Tomcat says, we are turning Japanese now with inflation. You said sings. Do you mean size? So Japan says they don't have inflation, but the Japanese cities are some of the most expensive cities to live in the world, whether it's Tokyo or some of the other major cities. They're top 5 or 6 normally in the world for expense. And, you know, for a couple $1,000 a month, you get very, very little in Japan at the major cities for rent and some of the other stuff. Now, healthcare is included, and I've heard from people and other YouTube videos, healthcare in Japan is cheaper, but cost of living in Japan is very, very expensive for many things. What most people are not aware of, and I learned this from watching the YouTube videos with Serpensa and LaoY86 and ADV China and China Nonstop and China Uncensored, is that the cost of living for rent and food has increased massively in China. China is just getting absolutely destroyed with stagflation, especially in the major cities. Alex Grant says, hi back, Alex. R. Ann Rousseau, Portsmouth, New Hampshire. Are you skiing up there? Skiing, snowmobiling, snowboarding? You get snow up there? I imagine you get a lot of snow up in New Hampshire. R. Ann Rousseau, if sovereign entities, wealthy, and banks are buying up gold and silver, why are the miners having a problem? Doesn't make sense. They have customers, just not small retail. So I assume you're talking about the producing miners. So first of all, mining in general is a very difficult business. There's so many variables, and in general, it's a bad business because margins cannot be maintained, and it's very high capex. The maintenance capex to maintain a mine, there's so many things that can go wrong at the mine. Governments can change the tax laws. Oil prices could go nuts, and that just totally destroys the miner's cost structure. About 33, a third of their input costs are energy. So if the energy prices were to increase a lot, the miners aren't hedged. The double whammy to the miners is where the metals prices go down and the energy prices go up, because then their margins are not only just squeezed, they're basically destroyed. So mining in general is not a good business. And there's very few miners that can actually control their costs. And this is why the 5 largest royalty and streaming companies, and there's a few smaller ones like Mavericks Metals, which has, I think, 12 assets online generating cash flow, and Metalla, which has a couple tiny royalties cash flowing. There's a few others that those businesses are good because their margins are protected better. They're more diversified with their cash flow. A lot of these mining companies, have to gamble. So if they're a junior producer bringing online one mine, and they only have one mine, they have to gamble the whole company on one mine. Debt, equity, dilution. The mine doesn't come on time and on budget. The miner's in trouble. They'll dilute the stock. The stock will crash. Maybe they're late on the loan payment. The banker's going to call on the loan. It's going to go bankrupt. I've seen this so many times. So there's so many things that can go wrong with a mine. If it's a larger miner and they try to grow at the wrong time, they could bring on a mine at a bad time. I think, was it Kinross or IM Gold? I think it was Kinross recently. They just announced that they were stopping trying to bring online a costly mine that was way over time and over budget. And the stock went up when they announced that they were stopping trying to bring the mine online because they have had so many problems with this gold mine and the economics weren't as good as projected. So the royalty and streaming companies are way better business models. They're more diversified with their cash flow. Their margins are protected. And the mining companies, there's so many things that can go wrong. And if the gold and silver prices go crazy a lot higher, you could see some of these countries, and this happens a lot, you could see some of these countries start to change the tax rules on the miners. But the miners also, even when the metals prices went up in 2010 and 11, their margins were sacrificed. So they started bringing online more and more marginal new mines and throwing in very marginal ore into the mine. And so when gold price went to 1900 temporarily and silver went to 48, 49, the miners were not making, you know, these blowout free cash flow numbers. They were profitable and they were making some free cash flow, but they were not making, you know, just eye-opening numbers for profits and free cash flow like you would think. And the truth is that the miners just have a really difficult time, whether it's a bull market, a bear market, or a sideways market, maintaining their margins. I would personally, this is just my opinion, if I was running a mining company and I had a couple operating mines, I would have started hedging my oil and diesel costs when the oil price crashed. So I would have locked in cheaper energy inputs, and yes, it would have cost more money, but I would have had more predictable margins. And you have seen no producing gold or silver miners do this. They just don't want to do it. Hi, Gus. Thanks for messaging me. I'm glad you liked the show. Hello, grass-fed meats. I don't know which country you're in, but the numbers from the U.S. Mint and elsewhere, a lot of American bullion dealers are having problems. They've cut their advertising budgets. Some of them are closing. Some of them are offering like deals on metal barely over spot. A lot of them are desperate to clear inventory right now, or at least they were in the not too distant past. Probram. Hello from Berlin. Oh, it's good. Well, we do have listeners all over the world. What do you think of Pan American Silver? I think, so this is not financial advice, just my opinion. I think Pan American Silver is the safest primary silver miner of the larger ones. I think they've made some really smart acquisitions long term. The danger that a company like Pan American Silver can get into is if they try to bring on a large mine with too much debt and the mine doesn't come on time and on budget. That could get the company in trouble. I would watch out for that. But the assets Pan American Silver does own are very good. They're a pretty low-cost producer. At the current silver prices we have now, the rally in silver, the primary silver miners may be making a little bit of free cash flow now, but not massive amounts of it yet. We'll find out in the earnings releases coming up if the primary silver miners are actually starting to make some free cash flow mining silver, but 2 months ago, Nolan Watson, who studies this industry probably more than anyone because he finances a lot of these deals, he said flat out that no primary silver miner was making any money mining silver, not even Pan American Silver, not even Fresnillo. And Fresnillo now has, I think, more revenue from their gold mining than they do from their silver, and they're a primary silver miner. Dan asked me if silver is money. So I think silver is definitely money and it's good for savings. I think, unfortunately, most people don't want to use metal, but we have the technology where we can use digital receipts on smartphones that represent a certain amount of gold or silver, and we could just have that. And we could have the banks that hold the metal audited. The mistake that most people make is they buy metal as an investment, not as for savings and insurance and wealth preservation. Mag Silver, Probe, Mag Silver is my favorite silver junior, other than Alexco, because Mag Silver has a credible partner to build the mine. They have the world's largest primary silver miner. They're partnered with Fresnillo in Mexico. The grades are 400 grams per ton at the mine at Juanicipio, and the geology at that mine is probably as good as it gets. That's the best silver mine discovery in decades at Juanicipio. So I could see Pan American Silver. I've heard rumors of Pan American Silver trying to buy out Mag Silver to get access to that mine. Sandstorm Gold, I think the stock has run up a lot. I think it was up 50% in the last couple months. So the stock for Sandstorm Gold, it's outperforming everything lately. It's doing really, really well. Maybe wait, this is not financial advice, but if you don't have a position in Sandstorm Gold or you're planning on adding to a position in Sandstorm Gold, I would probably wait for a little bit of a correction. Hopefully there's a little correction here. We'll see. They have assets now online. The Cerro Moro Silver Stream is online. They should get their first check soon from that. That's their single largest source of revenue now from Sandstorm Gold. So Cerro Moro Silver Stream is online. We've been waiting 3 years for that to come online. 3 years is forever now in the investment world. If you're a money manager and you tell your clients that they have to wait 3 years for big profits, they're going to fire you. They're going to be cussing you out every day and threatening to fire you. So no one can even wait 3 years anymore. Yeah, Sandstorm, there's a good article on Seeking Alpha from Adrian Hernandez about Sandstorm, and on a relative basis, I think Sandstorm Gold has outperformed pretty much every single gold stock and every single gold mining index by a lot. It's up 50% in the last couple months. The company is really, it's out of the startup phase. So the startup phase, there was mistakes, there was growing pains, there was a few bad deals, and I think the management team, he's one of the hardest working, smartest guys in the industry. He hired really good geologists, and I think, they have the right recipe now for success. They're out of the startup phase, and they're into that really sweet spot of a growth phase where they're going to be doing really good deals now. And they have a really strong foundation with diversified cash flow for growth. But Osisko Gold Royalty is also a good company, and they have a lot of cash flow, and they have a lot of cash in their balance sheet. So Osisko Gold Royalty is also a good one. Wheaton Precious Metals is a good one. Again, this is not financial advice. Do your own research and due diligence. I would much rather own those companies than a mining company, because there's so many things that can go wrong in a lot of mining companies. If you're going to trade the cycle, though, in the miners, you can make a higher return percentage-wise, but you're also taking on more risk. I get a lot of mining stock questions here. Remember, guys, I said I wasn't going to answer a whole bunch of mining stock questions. We're at 31 minutes now on this live stream. I'll answer maybe 1 or 2 more non-mining stock questions, and that's it. Tom says, thank you for telling us about Real Vision TV. I do enjoy some of their shows. Real Vision TV, for our listeners who are not familiar, I'm not getting paid by them. They do have 20% of their content now for free on their website, and it is worth the money. I think the cost of a subscription is down for their interviews, and they interview some of the best people in finance, money managers, hedge fund managers in the world. There was one guy who was calling out their content saying it was bad, but I think saying that the people go on there lie, and I just don't think so, because when the people come back on Real Vision for additional interviews 3 months or 6 months or a year later, they get called out if they lie or if they were wrong. So I don't think the people who go on Real Vision are intentionally planting lies. Someone seemed to insinuate that everyone who goes on there and speaks on there is lying. And I definitely do not think that. Because I've interviewed a lot of the people who go on Real Vision TV, and I would know if they're lying. In a lot of cases, I would know if they're lying. And they're not. Although that Miles Kwok interview, if they haven't released that one for free that Kyle Bass did, if half the stuff Miles Kwok alleges about China is true, it's just insane about how corrupt and how much of a credit Ponzi scheme China is. So I'm not sure what to believe, but if half of what Miles Kwok said about Chinese government and all the corruption and stuff there is true, China's one giant credit Ponzi scheme. Okay, Mike asks, do you see the coming BBB bond downgrades triggering a sudden sharp recession, significantly raising gold and silver prices? So, in the short term, gold and silver prices could go down, but then they would probably rally strongly. Honestly, Mike, it really depends on what the governments and central banks decide to do, because the rating agencies are complicit, in my opinion. I don't think the ratings agencies are going to do the right thing, and they've allowed this thing to these companies to borrow way too much money without downgrading their credit ratings. So I think some of these companies are going to blow up, but maybe the rules get changed. Because look what happened to the banks in March of 2009 when the FASB changed the mark-to-market accounting rules just for the banks. So we could have something similar to that. And this is why I've stressed that the #1 rule is that unfortunately, if you have money invested for your retirement or savings, or you're just trading the market, or you're going to be an investor for a couple years, that you have to pay attention to the rules changes now. We're the new normal now since 2008 and the Lehman Brothers incident is that all the rules can potentially be changed very quickly. And they may not even tell us immediately that the rules are changed. Sometimes they may only tell us the rules are changed if they think it'll help like an entire industry from going bankrupt, or they don't want like a run on banks or something along those lines. But I do know, Mike, that there are a lot of hedge funds out there. I interviewed Kevin Duffy a couple of weeks ago from Bearing Asset Management. There are a lot of hedge funds out there looking for the next General Electric. That has too much debt, their revenues fell off, they can't make the debt payments, their creditors are about to downgrade them. So there are going to be hedge funds that are doing that. But, you know, if the rules change, then those hedge funds aren't going to make the money that they thought. Cybersecurity ETFs. So if you're looking to get into an industry that has the safest long-term growth, the cybersecurity stocks are not value plays, but the cybersecurity industry, even if you're looking for a new job. So if you're learning how to I shouldn't say learn how to code, right? Because that's the politically correct stuff. People are getting banned from Twitter for saying that, right? The stupid learn to code stuff. So if you tell a journalist, I don't know if you guys heard about this, but if you tell a journalist who just got fired from BuzzFeed or Huffington Post or something, if you tell them to learn to code, apparently that triggers the politically correct snowflakes now. But seriously though, non-politically correct stuff for career advice, if you're looking to change careers and maybe get into a safer job industry long term, the cybersecurity industry has 8 to 10% growth every year, compounded annual growth for many, many years. The cybersecurity defense will always be behind the hackers. And now, in the new normal that we have now, you have governments hacking governments, you have governments hacking corporations, you have corporations hacking corporations, corporate espionage, and then you have hackers hacking like consumers and retail, you know, stealing credit cards and all this stuff. So I don't think any of that is going away. So the majority of corporate America is vastly underinvested in their cybersecurity defenses. Vastly. We are talking like hundreds of billions of dollars underinvested. The U.S. corporate America is vastly underinvested in their cybersecurity defense. So that is a long-term trend. In the short term, I haven't paid a lot of attention to the cybersecurity ETF hack, so it's probably volatile given the valuations on those stocks, but long-term, this trend is not going anywhere. In fact, I think the best long-term growth trend is cybersecurity. So if you're looking to switch careers, learning how to code, getting into cybersecurity industry is probably a pretty safe career prospect. Okay, Jessica asked, since 1967, interesting. Well, from 1967 until President Nixon closed the gold window, all the central banks, because they were still allowed to redeem the dollars for gold internationally, because remember, Americans weren't allowed to own gold for an investment. Americans were only allowed to own, I think, like numismatic coins and religious gold. And then that was re-legalized for Americans. They were allowed to own physical gold again in, I think, 1974. Was it 74 or 71? I know Nixon closed the gold window in 71. I'm trying to remember, like, off the cuff if I can, the exact date. But Nixon closed the gold window because the U.S. was going to lose all of its physical gold, and that was technically a default. So there's a book out, an ebook for free you can read by Jacques Rueff. He was I think the head of the French Central Bank at the time. He was giving advice to Charles de Gaulle, and it's called Age of Inflation. And it talks about why France was converting all of its dollars for gold and how the U.S. was abusing its privilege as a world reserve currency and things like that. So Google Jacques Rueff, Age of Inflation, if you want to read about that. There's other books about that, but that's the one I've read. Hello, Probe. I cannot give financial advice. I'm sorry. So there's a bunch of mining stock questions in here. We're at 39 minutes here on the show. I'm going to go take a break from work for right now, and I'm going to go watch the hockey game the Caps playing, so I'll talk to you guys later. Everyone have a good night.